Welcome to Orange US Stock Research. Today we dive into Shopify, ticker symbol SHOP, a polarizing yet powerful e-commerce giant. Let us cut to the chase. After rigorous analysis of financials, competitive positioning, and market environment, our final score is 74 out of 100, resulting in a hold rating. Shopify shows spectacular revenue growth, massive free cash flow, and an impenetrable merchant ecosystem. They actively shape the artificial intelligence revolution with innovations like Agentic storefronts. However, trading at a trailing price-to-earnings ratio over 120 leaves no margin for error. Furthermore, macroeconomic shifts, including the elimination of the de minimis tariff exemption, pose real challenges. Over the next few minutes, we will unpack their business model, financial results, competitive moat, growth potential, and valuation scenario analysis. To understand Shopify's true value, we must examine its core revenue model. Shopify is often misunderstood as merely a website builder. In reality, it is the comprehensive operating system for modern retail. The company operates through two primary streams: subscription solutions and merchant solutions. Subscription solutions provide a highly stable baseline of recurring monthly fees. However, the real growth engine is merchant solutions, which accounted for roughly 76% of total revenue in 2025. This segment is driven primarily by Shopify payments, where the company takes a percentage of every transaction processed. Last year, a staggering $378 billion in gross merchandise volume ran through the platform. This model brilliantly aligns Shopify's success directly with the financial success of its global merchants. Shopify's fundamental strength lies in its aggressive expansion beyond simple online storefronts. They have transformed into an indispensable utility for over 4.6 million active stores globally by centralizing critical business functions. Through Shopify Capital, they provide vital lending to growing merchants. Through the Shopify Fulfillment Network, they offer sophisticated logistics solutions previously reserved for massive corporations. Furthermore, their point-of-sale hardware deeply integrates brick-and-mortar retail with online inventory, creating a true omnichannel experience. By capturing every touchpoint of the merchant journey, from inventory management to final delivery, Shopify increases its take rate while simultaneously reducing the merchant's operational complexity. This comprehensive ecosystem approach ensures that, as a merchant scales from a garage startup to an enterprise brand, they never outgrow the Shopify platform. Shopify's financial performance in 2025 was exceptional. Total revenue reached $11.56 billion, representing a massive 30% year-over-year increase. The fourth quarter alone brought in $3.67 billion, accelerating to 31% growth. Even more impressive is the profitability transformation. Operating income surged to $1.47 billion, pushing operating margins to approximately 12.7%. The most critical metric, free cash flow, exceeded $2 billion for the year, achieving a 17% margin. The fourth quarter marked their 10th consecutive quarter of double-digit free cash flow margins. This cash generation fortifies a pristine balance sheet with $5.8 billion in cash and zero net debt, allowing aggressive investments without diluting shareholders. A great business requires a durable competitive moat, and Shopify's is exceptionally wide. In the United States e-commerce platform market, Shopify holds a dominant share of nearly 30%. Their global gross merchandise volume is now equivalent to 66% of the largest competitor's third-party marketplace volume. The foundation of this moat lies in prohibitively high switching costs. Once a merchant builds their store, integrates their specific inventory systems, connects customized accounting software, and trains their staff entirely on the Shopify dashboard, the operational friction of migrating to a competing platform becomes immense. This deep structural integration results in incredibly low churn rates among established merchants, providing Shopify with highly predictable recurring revenue and the pricing power to gradually increase subscription fees over time. Beyond switching costs, Shopify is building powerful, self-reinforcing network effects, primarily driven by Shop Pay, their accelerated checkout system. Shop Pay is arguably the most critical consumer-facing asset Shopify owns. With over 100 million registered buyers storing their payment and shipping information, Shop Pay dramatically increases conversion rates for merchants. Higher conversion rates attract more high-quality merchants to the platform. More merchants mean more consumers are prompted to create a Shop Pay account, creating a virtuous cycle that competitors struggle to replicate. They are not just providing back-end software. They are establishing a unified, trusted commerce identity across the entire internet. This scale attracts thousands of third-party app developers, further enriching the ecosystem and making the platform even more indispensable for modern retail. Looking ahead, Shopify is aggressively positioning itself at the forefront of the artificial intelligence revolution. The market has heavily debated whether AI search engines will disrupt traditional e-commerce funnels. Shopify's strategic answer is agentic commerce. They recently launched Agentic storefronts, a groundbreaking feature allowing merchants to sell directly to users inside AI platforms like ChatGPT and Google Gemini. Management reports that orders originating from AI search have increased 15-fold since January 2025. Shopify does not want to compete with AI search. It wants to be the invisible back-end commerce engine powering the entire AI shopping experience. By integrating predictive analytics for inventory management and generative AI for product descriptions, Shopify Sidekick is dramatically reducing merchant workload while driving higher sales velocity across the platform. Beyond artificial intelligence, international expansion and business-to-business commerce represent massive, untapped growth runways. Historically focused on direct-to-consumer sales in North America, Shopify is now rapidly moving upmarket. In 2025, international revenue grew by an impressive 36%, demonstrating the global portability of their software. Even more striking, their business-to-business gross merchandise volume skyrocketed by 96% year-over-year. By serving larger enterprise clients with complex wholesale needs and expanding their localized footprint in Europe and Asia, Shopify is significantly expanding its total addressable market. The company's guidance for the first quarter of 2026 projects continued revenue growth in the low 30% range, strongly indicating that this momentum is sustainable and that their strategic investments in enterprise-grade features are yielding substantial returns. No investment is without risk, and Shopify currently faces several significant macroeconomic headwinds that demand close monitoring. The most pressing external factor is the shifting landscape of global trade policy. The recent elimination of the $800 de minimis tariff exemption has severely impacted cross-border e-commerce. Daily duty-free package volumes have plummeted, directly affecting dropshippers and merchants who rely heavily on international suppliers. Furthermore, revised Section 232 tariffs implemented in April 2026 are adding substantial costs to international supply chains. While Shopify itself does not directly pay these tariffs, its merchants certainly do. If merchant profit margins are severely squeezed by these rising costs, it could lead to higher platform churn rates or significantly reduced spending on Shopify's higher-tier services. In addition to macroeconomic pressures, Shopify faces the internal risk of executing against astronomical market expectations. The company experienced a slight gross margin contraction of 200 basis points in the fourth quarter of 2025. While overall profitability remains robust, any further degradation in gross margins could severely spook a market that is pricing the stock for absolute perfection. Furthermore, ongoing regulatory scrutiny regarding worker classification in the gig and creator economies could indirectly affect the broader e-commerce ecosystem that Shopify relies upon. Competitors like Amazon's Buy with Prime also present an ever-present threat to Shopify's checkout dominance. When a stock trades at a premium multiple, the margin for error is zero. Even a slight deceleration in growth can trigger a massive multiple compression. This brings us to the most critical aspect of Shopify, its valuation. As of April 2026, the stock has experienced a significant pullback, dropping roughly 27% year-to-date from its peak. Despite this sharp sell-off, Shopify still commands a premium valuation with a market capitalization of approximately $144 billion. It currently trades at a trailing price-to-earnings ratio of roughly 120 and a forward P/E ratio of 63. This implies the market expects sustained hypergrowth and flawless execution for years to come. While analyst consensus estimates suggest a fair value of around $186 per share, our proprietary discounted cash flow models indicate the stock might still be slightly overvalued at current trading levels. To provide a comprehensive framework, we consolidated our scenario analysis projecting to December 2028. In our base case, Assuming robust 25% annual growth and stable margins, we project a target price of $218, implying an 84% total return. In our bull case, where AI-driven agentic commerce dominates and growth compounds over 30%, the target price reaches $295, an extraordinary 35% annualized return. However, in our bear case, where tariff pressures restrict consumer spending and the market punishes high-multiple software stocks, the target price falls to $141. This pessimistic scenario yields only a 6% annualized return, highlighting the severe risk of multiple contraction if Shopify fails to maintain its hypergrowth trajectory. Synthesizing this comprehensive analysis, we arrive at our final scorecard for Shopify. We evaluate the company across 5 key dimensions. For business fundamentals and competitive moat, we award a stellar 9 out of 10 due to their incredibly sticky ecosystem. For financial health, another 9 out of 10, reflecting 10 consecutive quarters of double-digit free cash flow margins and 0 net debt. For growth potential, we give an 8.5, driven by aggressive expansion into AI, B2B, and international markets. However, for risk profile, the score drops to a 6 due to severe tariff changes and macroeconomic uncertainties. Finally, for valuation, we assign a strict 4.5 out of 10. Adding these up, Shopify earns a total score of 74 out of 100. So what is the final verdict? Shopify is undeniably a generational company building the definitive infrastructure for global commerce. Their financial performance proves they can grow rapidly while generating massive cash, led by a visionary management team executing at the highest level. However, as an investor, you must separate a great company from a great stock price. At over 60 times forward earnings, the market demands absolute perfection. External risks regarding international tariffs and supply chain costs cannot be ignored. If you currently own the stock with a low cost basis, there is no fundamental reason to panic sell. But if you are looking to deploy new capital, we recommend exercising patience. Keep Shopify on a tight watch list and wait for a broader market correction. Financial markets are a continuous conversation, and we want to hear from you. Do you believe Shopify's aggressive push into agentic commerce justifies its current valuation, or will macroeconomic headwinds force a further correction? Please drop your thoughts in the comments below. Finally, please review our standard disclaimer. This video represents personal opinions and independent research, intended strictly for informational and educational purposes only. It does not constitute personalized investment advice or a recommendation to buy or sell any securities. The stock market involves significant risks, and past performance is not indicative of future results. Always conduct your own extensive due diligence and consult with a certified financial advisor before making investment decisions. If you found this analysis valuable, please like, subscribe, and turn on notifications. See you next time.